Hey everyone, good evening. We're done now with the overview. So we're still on the overview tab, and then I'm going to go to the calculation tab now. Right? So if you want to go to each tab or in Excel, you press Control and page down, which I need to enable first. Sorry. Control page down, page down. Then if you want to go to the very top, Control page up, page up. That's your navigation, right? So control page down, I that's actually a calculation now. So we're gonna do the same thing. We have series one, two, three, four, five, and then we're gonna do first the first calculation, which is actually on the bonds. And then we're gonna go now from left to right. Okay, so just want to make sure we have that away. Yes. So we're gonna do calculation of bond. Let me make it bigger, and then we go through after. Zoom in. We're gonna do zoom in and zoom out today. Okay. Now, calculation of debt or the cost of debt. So assuming that the firm or the entity is going to be one coherent example, right? Assuming the firm is preparing to issue new debt, and the debt would actually pay an interest of $90 a year, and then it will have a 15-year life. So basically, that's the maturity date. Uh, at that time, it will be me as an issuer of the bond, and you as the investor. You as the investor will receive 1,000 at the end of 15 years, but you as the investor will be paying 968 and 50 cents on year one. So basically, present value. In the future, after 15 years, you will get $1,000 paid back to you, plus the interest of $90 per year for 15 years. So similar to what we have done before, right? Sounds similar. We know the formula. We use the Excel function. So the cost of debt is basically this. We talked about it a while ago. And then for this bond topic, we would need to compute for the YTM or the Y. When I say YTM, we know it's yield to maturity, or Y is actually the yield, right? So given, so this will be your Excel formula, right? It's like a present value and then also a present value and then a future value. But this time around, we'll introduce you to a new formula, which is actually equals rate. We did equals PV, present value. We did equals FV or future value. Now we're going to do equals rate in Excel, which is actually looks like this. And using the same information as we had before. So here, the number of periods, NPER is 15 years. The payment is like what? The annuity. So every year, you'll get $90. So basically, that's the coupon amount or the interest amount. And then the present value, you would need to pay in order for you to invest on this bond, right? It's actually 968. So that's the payment. I'm sorry, the PV, not the payment, the PV. Make sure it's clear. And then you have the I'm going to say again fair value, the future value of 1,000. So right now we're not going to use this letter T, which is actually the tax rate, right? But like wanted to show you on the equals rate formula in Excel. Okay, let me take it out. So here's the formula. It's a picture. I just inserted it so you can see it. I'm going to now press F2 so you can take a look at it. So it's similar to how we actually align it, equals rate. The rate is basically 9.4. So that's the yield, right? So because we now solve for Y, I just need to apply 75%. Why 75? It's 1 minus 0.25 or 1 minus 25%, right? 4 or 25%. It doesn't look like 25. And then that one is actually this side. So I'm going to get 7.05. Let's make sure that it's actually correct. I have 1 minus and then link it to 25. And then I have Y or the yield to maturity at 9.4, which is a calculation of equals rate. I'll just use Y because basically that's your interest rate calculation. So we learned something new as a formula, which is actually getting the yield through Excel using equals rate. Now, just a note, if this is actually a loan, not a bond, then straight up, this Y will be the interest rate of the loan. Then you just multiply it by 1 minus the tax rate. It's just straight up. But because it's actually a bond, we need to compute for the yield to maturity. So you can actually have financing done through bonds or debt financing done through bonds or debt financing done through um, loan. Now, we're good with number two, not too bad, right? So we're going to go to number three, both on CAPM and then also on the DDM or the dividend valuation method, right? So we'll go first with number three on existing retained earnings. So why do we need to say, just a quick review, why do we say existing retained earnings? The company may not issue new equity. It would use their internal funds. Internal funds meaning it would use the net income accumulated in prior years or even last year. That will be retained earnings. And then internal financing is actually using internal financing means it's using of its own equity. That's why it's gonna be using a CAPM method. Or if you're gonna be issuing stocks, then you need to compute using the DDM with flotation cost. Or if you're doing dividends, then you can, without any new issuance, you can actually use also KE, which is actually the DDM formula, which we're going to break it down now. Okay. So number three, using existing retained earnings. So if it's actually using the existing retained earnings, what you can do, I'm going to move it here. So it's the same firm, right? So it's a continuation. The same firm issued the new debt, but it's needing something also. But it's issuing new preferred stock. Sorry, this should not be number four. Let me make a change. So this should be, how do I do this? I can do it this way. I'll make a switch, guys, okay? This is now number four. This is now number three. Apologize. Apologies on that one. So number four, the same firm is issuing new debt, who issued new debt is also considering and is issued new preferred stock with an estimated annual dividend of 10.5 per stock and with a price of 100 per stock and an estimated flotation cost or selling cost of $4 per share. Now, we will be using this formula, which is actually KP, P referring to preferred stocks. Normally, if it's equity, it's KE, right? But now we're making a distinction between what's preferred because of the flotation cost, because it's a new issuance. So I need to actually make some changes, or even the book actually uses the word KP. So DP is actually the annual dividend for the preferred stocks minus the price of the preferred stock, P, normally it's PO, right? But price of the preferred stock, P and subscript P, minus F, which is the flotation or selling cost of the preferred stock. So if I have this, I'm going to do F2. So 10.5, the annual dividend over the difference between the $100 preferred stock minus $4. So your cost of capital relating to equity, I would say cost of equity under preferred stock is actually 10.94. If I issue the bonds, it's actually 9.4, but preferred stock, we always say that in most cases, the cost of debt is actually, or the cost of equity is higher, cost of debt is lower. It mimics that theory here, right? Now, the same company basically said that, you know what, even though I issued debt through the bonds on our example, bond rate, the rate of the cost of debt is actually 7.05, then it issued preferred stock. The cost of equity on that preferred stock is 10.94. It's not enough. It needs to use its own funds or internal financing, meaning retained earnings. And then we would not be using the dividend discount model or the dividend discount method, right, on the common stock. So it's the same formula when you think about it. It's just that it does not include flotation cost. Why? Because you are not considering, you're not issuing new stock, so there's no flotation cost. I just have P is for preferred stock, E is for the cost of equity, P and then P subscript P is for the price of the preferred stock, PO or zero is actually the price of the common stock as of the issuance date, as of today, and then G is actually the growth rate. So why do you have the growth rate now? The growth rate is that because the stock is your internal stock, and then that's the cost of you using that fund. It's an accumulation of net income of prior years. So you need to incorporate the growth of that stock or that section of your cost of equity. That's why you have a plus G, which is the growth rate. I'm gonna go down a bit. So similarly, the dividends is $2. The price is 40. If you divide that first, and then plus, so 2 over 45% plus 7%, which is the G, that will be 12%. Let's make sure it actually goes through with I'm gonna highlight here and press F2, right? And then I'm gonna make slight correction, apologies, so that should be 1, the dividend on the price today, okay? So it's actually 12%. Now, remember we talked about if the company uses or if the company issues dividends, then I would use the dividend valuation model or the dividend the DDM or the dividend discount model or the dividend valuation model is the same. But if it doesn't have or it does not declare dividends, then I can use CAPM. So CAPM would be, okay, let me make sure CAPM is basically the cost of equity is equals to a risk-free rate plus the beta of KM, which is actually the market rate or the required the expected return of the stock of the in the market minus risk-free rate. Yeah, which is actually here. So when I was studying this one before, I was say it out loud and talk to myself that this is actually the formula. So it actually you memorize it or it becomes a second nature. But of course, you need to sometimes you need to go back after a few years or not. But like later on, we still use this one for work. Um, I'm in a building right now, and every year this building that we own goes to an appraisal value. And then I would actually recalculate the appraisal value to do a discounted financing methodology to show whether the goodwill that we have in our company is good or not. It's more of an accounting practice, but we will touch base on those in the next few weeks on how cost of capital is being used in capital budgeting. So we will go there and then we will show you real world applications, right? So that's why CAPM is method we use, because I work in a company that's privately held, we do not issue stocks. So I use actually our the CAPM method. At the same time, you can be a company that does not issue dividends, but your stocks are listed. You can do CAPM. Ours is a privately held company that I work for. We are not listed in stock exchange. It's a local company in Guam. So that's why I use CAPM. And but you would tell me, so but what is the trading, what's the market rate that they use for how do you mimic the stocks, right? If you're not listed. Remember the beta is your movement of your stock to the S&P 500. Another application of CAPM is that what is an industry that my company is within, and then I use the data that's posted and collated and compiled online from statistics and whatnot on the industry that similar industry that the company is under. So ours is actually a real estate company that actually leases on buildings. So there's a code for that, and then I use that data when I pull it out from online, depending on the industry data that I need to pull out, and then depending on the years that I need to use as comparison. So there's real world application on what we're actually talking about. Can be a bit more complicated than that, but I wanted to just give you an idea that it does work, and we use it even for accounting. Our accountants use it. That's why there's good in understanding cost of capital. So with that, I'm going to segue back on CAPM. So the risk-free rate, normally the treasury bills, and the beta coefficient. So a beta greater than 1 indicates a greater volatility or price movement than the market, while the reverse would be true for a beta less than 1. So inverse, right? Now, KM is the return expected in the market, but measured using an appropriate index. Those are normally declared by industry guides. Now, just in case, this is actually the assumption, right? RF is 5.5%, KM is 12%, and then beta is 1. If this will be the case, it's the same as how we did it. We're just trying to mimic it, right? That's why we do the given or the assumption. The formula will be like this. Let me clear it up. There you go. Risk-free rate of 5.5 plus beta multiplied by the difference between the market, expected return of the market, and then the risk-free rate. Okay. Now we have now calculated the cost of debt and then the cost of equity, right? So remember, the weighted average is actually the cost of capital. So we would now compute the weighted average cost of capital, or a lot of folks would call it WACC, WACC. I wanted to make sure we discuss this one, right? I made sure we have a comparison between CAPM and then the dividend discount model. CAPM focuses on risk, taking into account beta, which is actually the systemic risk, and then widely acceptable. DDM focuses on dividends, just in case that there are dividend payments within the industry or that the company that you're measuring. Now, if I now need to compute weighted average cost of capital, so the same company that we were looking at on the left side. So given that each type of financing is based on the capital structure of the entity, we need to calculate the weighted average capital. So KE, cost of equity, plus, that allocation, right, of KD, which is cost of debt. And then here, better explained, so I put the numbers here to make sure it's actually there, but like I need to make sure that you can see it. So KD, KP, the preferred stock. Remember, it issued new stock. We calculated it at 10.94. Where is that? It's actually here. Well, I'm going to show you the trick on that one. if you have a big spreadsheet. I'm going to press F5, sorry, F2. I know it's H25, right? So if I want to find where is H25, which is actually on the left side of the screen, control and then bracket, the opening bracket. Then now, if I actually move my cursor, there you go, see? It's actually H25. Then I want to go back to the right side, right? Press F5, then press enter. Then I'm back now here on 7.05. Okay. So that one works whether you're actually on the same tab or a different tab somewhere in your worksheet. 10.94, M18, control, and then the key after letter P, which is a bracket. 10.94, so I can see that. I'm just going to move my cursor so I can see what's the description. Okay, I get that. Then I'll go F5 and then go back to AG31, where we're at. AG and then 31. So I can go back there. And then that's the new issuance of the stock with flotation cost consideration. And then this is the common stock, control bracket, the common stock that we use with a 7% growth rate. Then F5, enter, then I go back. Now, in our scenario, we're just saying that in this case, so just in case that, just to be sure that we're not confused, right? E is equity, and then in our case, it's 70%. Basically, we're giving it as an assumption. D is the debt, it's at 30%. So when you add both, it's always 100%, right? Because V is the 100%. Okay? And then now what we're trying to do is that we're just saying that out of the 70%, which is actually equity, right? 10% of that is coming from preferred stock, and then 60% is coming from common stock. So 60% coming from common stock, and then the 10% coming from preferred stock is actually here. And then the rest are the 30%. That's the weight, basically, is for debt. So why do we need to assign the weight so proportionate, right? So right now I do 30% over 100%. Of course, it's still 30%. But sometimes it might be a dollar amount. Hey, on the balance sheet, debt is amounting to 1.5 million, or in our example, 3 million, then 2 million, right? The original one that we started with the first video. So it can be a dollar amount. That's why the allocation can be like that. You might need to add to get the total of 100% or the total equity plus debt, because it might be a dollar amount. But in our case right now, the assumption set is based on percentage. So I have that. Check, it's 100%. And then I have here A and B. C, the weighted cost, is A times B. And then basically, I'm just multiplying it. Now, 10.41 is the weighted average cost of capital. Basically, that's what it is. So the the weighted average cost of capital is 10.4. And then let's make sure it's clear. Here you go. Now, we did the calculation. I'm going to go back to our presentation just to be sure we have this. Because we're going to go with one more topic, right? I wanted to make sure we have this topic done. These are calculation. This is actually what we go through each of the slide. The question is, what will be the optimum weighted average cost of capital? The weighted average cost of capital, you want it to be as low as possible. So it's not too high. Why? If your weighted average cost of capital is way too high, meaning that it's costly for you to deploy capital to any projects. That's why you want to keep it on the minimum. Remember, we talked about that the cost of debt is lower by percentage compared to equity because investors ask for higher returns. But what is the mix, the optimal mix? Why do I say mix? Remember, I can say that 20% of my balance sheet will be on debt and then 80% is on equity. Or I can structure the company that I'm going to create at 40 and 60 or 60 and 40. So you have plan A, plan B, plan C. But you would need to see the lowest one, which is actually 10.3. So this will be ideal. Now, if you do the math, you would say even you can do 100%. You might say that you can do 100% debt, and then your debt will be the lowest. Not correct. Why? If you see it here, your debt rate changes, right? And then you would think that like, oh, and equity also changes because the expectation from the market always change. And then remember that the longer that you had the debt, the higher the interest rate because you're putting the money there for a long time. Um, if you are the bank who loaned the money to somebody and then the terms is actually 15 years and you are the one asking me for money, so I give you, okay, 15 years. Me, the bank, I would want to make sure that the interest rate is actually on a higher range because I'm going to give you, say, $5 million for 15 years. I'm not going to see it until after 15 years because you're just going to be paying me as you go through, or you can even structure the loan we're in. You don't pay until the 15th year, the full principal amount of 5 million balloon payment. But each year, you, the one who owes me money, the bank, would pay me only interest each year. Can be that way also. So the longer that the loan is, the interest rate will be higher. And then that's why structuring the company's weighted optimal mix of capital can be a scenario-based approach. But the goal will be to actually have the lowest one. Now, what I'm going to use this explanation. So the cost of debt, oh, okay, we'll just use this one, then we'll segue to the other one. The cost of debt, if this is the percentage, right? So this your y-axis is actually the percent. So see, the percent is lower on the cost of debt. And then the cost of equity is actually higher than the cost of debt. And then normally it goes to a dip, right? Depending on the mix, right? So depending on the mix between the asset, the debt and equity. But I'll do this with a timeline. There you go. So here's a timeline base, right? The longer is your time, what will happen is that your cost of debt would actually be higher. So your cost of capital, KA, given that there will be more than time, 1 year after the first year, 1 year after the second year, your cost of debt will be higher, the cost of debt, right? And one is equity. So cost of equity is higher, but the cost of debt will also go higher. This is debt, right? So why do I say debt is the second there? Because debt is actually lower as a rate compared to equity, right? That's why the optimum time needs to be computed when everything else is low on the average, right? That's why we always say we need to get the optimum weighted average cost of capital, which is the lowest point. There you go. Because it's still here, high, and then it will go to the lowest, and it will pick up again because it changes on the mix that you have, and then you have the period of time. So that's the theoretical explanation of that. I know it's more of a visual, um, but that's actually important to note, right? So here on the book, if you read the book, right, we computed 10.41. Where did we get that? We're using the same thing as our 10.41. But now, not just a PowerPoint, but you can do play with it, recompute it. Right? I'm going to go back. So we're saying that if A, B, C, all the way to H are projects, and then we are saying that, hey, project A would return a 16%. What's the cost of capital? 10.41, the weighted average cost of capital. Okay, I'd like to fund this project. It's good. Letter B or project B, 14% return on investment. My cost will be 10.41, and then I'll get 14% in return. Oh, go for it. Letter C, go for it. Letter D, go for it. But anything, actually even E here, I would think maybe I don't want to support this project. I don't want to support F, G, and H. I know E here is within our threshold, but now I need to be more cognizant. What are the qualitative? Because I'm only competing for the quantitative. So that's what we do also when we create our business proposals to my boss, right? I need to show both qualitative and quantitative. So I do a full calculation of capital budgeting, which we will discuss next week, actually. So I'll show you some practical applications as well. Okay. So this is what it's actually saying. Your cost to deploy capital is 10.41, which is the WACC, weighted average cost of capital. Any projects that people are telling you to invest on, if it's above 10.41, then I'm okay for it. So that's why above, remember above, the operative term is above, right? That's why the weighted average cost of capital is the same as the discount rate or the hurdle rate above, right? So discount rate. So it's the same. It's what we're actually having. Okay, I want to explain that, and then I think it's the same discussion that we have. I'll press escape. Let me go one more on CAGR. CAGR or 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 I took this one out. Kindly hold. There you go. CAGR is actually a compounded annual growth rate. So I need to show you a calculation for compounded annual growth rate. Um, you can actually compute it in two ways. The first calculation would be basically a math that you would do in Excel, right? Not a function in Excel. The beginning value divided by, oh, the ending value divided by the beginning value. When you think about it, the future divided by the now to the power of 1 over the number of period minus 1. Or you can do an Excel function, which is actually equals rate. And then you have NPERV, comma, comma. So the first comma that I skip is the payment, and then PV, and then future value, and then you close it. Okay. Basically, what we skip is actually the payment, which is what is payment again for us? Is the annuity, right? And then remember when you think about it, PV is basically the beginning. Then FV, future, is the end value. So it's almost the same the way that you calculated. Guess is actually you leave it blank. Either you want an exact match or not, but you actually leave. You don't consider the last two. So this is the formula that we have. And then what best way to explain this is through an example. You have an investment. We'll do two example. It's either an income or return as a calculation. You have an investment of 1,000 on year one, but on year five it became 2,143. So interest is being applied, and then the 1,000 with interest became 2,143. Give me the compounded annual growth rate. Remember that amortization table or that we did before, like the big Excel file. Basically, we're just understanding the rate. I'll do it this way. Future value or the end value will be 2,143 divided by beginning value, which is 1,000 to the power of 1 over 5, the number of years that has lapsed, minus, close, minus 1. 16.47. We'll do the same with equals rate. Equals rate, 5 years. I know normally we would link it up, right, on the given, but now I just typed in 5 years, comma. I'll skip payment, which is actually the annuity, skip it by doing a comma, minus the present value. I need to make sure you have the minus, right? Then comma, future value. 16.47, that's correct. If I take out the minus here, I'll take out, okay? So you see that there's a minus there, sign. If I take it out, it's going to do that. So that's why you know your answer is incorrect. So Control Z, undo, and then I just did a visual to link it up. Now, your CAGR does not need to be the investment now and the investment in the future. It can be also the dividends between prior years, right? When you started off and what you have now. If the dividend in year one is $1 or year one is $2, and then in the now, after 5 years, it's 2.65, what's the CAGR or the change of that dividends from $2 to 2.65? It's 5.79, which can be the same formula calculation. Okay, don't forget minus 2 on the PV. So that ends our class for today or for this week. We have 2 videos for today. Make sure to go through the quiz and then post it. If you do have questions, we are halfway. We don't have a midterm exam, right? So most of the things that we do is actually quizzes. Make sure to practice on the quiz or practice on the Excel files that I'm going to be loading and also on the quiz. If you have any questions on any of the topics that we have discussed before, please do reach out to me. Okay, so thank you everyone. Then and please do reach out if you have any questions. Thank you. Have a good day.